Good morning. My name is Andrea Jackson, and I am the Deputy Compliance Officer for the District Department of Transportation's Equity and Inclusion Division. I want to personally welcome you to part 2 and the last webinar of the A&E Toolbox Financial Webinar Series. During today's webinar, it is our intent to provide you with valuable information and resources which will empower you and your business to be successful when participating in DDOT's contracting opportunities. As an agency, we are continuously exploring ways to improve how we connect and engage our DBE, CBE, and small business community by implementing new and innovative programs, technologies, and services aimed at expanding accessibility to key decision makers, improving information, and resource sharing. The District Department of Transportation's Equity and Inclusion Division is working in collaboration with the Office of the Chief Financial Officer, Office of Assurance and Compliance. Let me say that again so we can understand who we are working with today. So you will be hearing from our Office of the Chief Financial Officer's Office of the Assurance and Compliance Division to present this toolbox series with a focus on doing business with DDOT. We want you to learn what it takes to be compliant with agency financial requirements, improve your skills and knowledge on how to prepare bids and cost proposals utilizing appropriate and indirect costs, build your knowledge and expertise on compliant and with required federal acquisition regulations, that's the FAR 31. So to this end, I just want to let you know that on May the 18th from 9 to 1 o'clock, DDOT will host its second virtual DBE networking event. It will matchmaking opportunities with our prime contractors. It'll give you access to financial information and access to other types of bid opportunities that you may not have gotten. So I want to go ahead on and start this program. But before I do that, let me introduce our wonderful speakers who will be sharing with you today. I have the pleasure of introducing two powerful women during Women's History Month who give you the tools that you need that are necessary to make this happen for you. First, we have Monica Miles, Managing Partner of MH Miles Company. Monica is a certified public accountant and certified fraud examiner with over 15 years of experience in the transportation industry, specifically federal acquisition regulations, cost principles, and compliance. Ms. Miles specialized in job costing, indirect cost rate development, accounting system compliance, and training. She provides consultant audit services to various departments of transportation, including DDOT. Next, we have DDOT's own Catherine Valentine, who is a budget officer for the Office of the Chief Financial Officer at DDOT. She oversees the annual operating budget of approximately $400 million, which include the Washington Metropolitan Area Transit Authority subsidy and approximately $1 billion in DDOT capital projects. Ms. Valentine manages the Office of Assurance and Compliance Division, which ensures financial compliance with the FAR 31 regulations and district contracting and procurement rules. On behalf of the Director of DDOT, Everett Lott, and my Chief, Nana Bailey Thomas, I want to again thank everyone involved in putting together this webinar and thank you for taking the opportunity out of your busy schedules to be here today and your commitment to the success of the business and the DBE program. So without further ado, I would like to introduce Ms. Monica Miles.
Thank you so much. I'm going to turn it over to Catherine Valentine just to go over some housekeeping rules.
Okay. Welcome to the A&E Toolbox Series. This is part 2. I want to mention that the last part, March 9th, the adequate accounting system was recorded. And feel free to contact the Equity Inclusion Division at DDOT if you need to get a hold of the recording that will be available. Sorry. And then today, on March 16th, we are discussing the executive compensation related party transaction and indirect cost rate schedule. So, and this series will also be recorded as well. And so the whole goal of the A&E Toolbox Series is to provide you with guidance and hopefully to help you be successful and profitable in a compliant way. So now I'm going to discuss a little housekeeping rules. Right now, everyone is on mute, and so you cannot unmute yourself. And this will help us make sure that we can run the series fairly smoothly. However, also your camera is shut off by default as well, and you won't be able to share your video. So another piece, in order to chat, we will have the chat box open for questions, which will be read by Tatiana Stevens, and we will do the interaction that way. And other than that, if you have any questions, please feel free to put them in the chat. And we hope you enjoyed this part 2 of this series.
Thank you so much, Catherine, for doing all the housekeeping. And now I just want to say good morning to everyone. We're so glad that you were able to present part 2 of the A&E Toolbox Series. So today we're going to actually discuss 3 topics that are critical for A&E firms to understand when they provide services on federal aid contracts. So just a little heads up, we will absolutely be doing calculations, especially when we're talking about indirect cost rates. So if you need a second to grab your calculator, please do that so that you can actively participate in the session. Okay, so our learning objectives for today are to understand indirect cost rates and their uses. That's going to really be the majority of what we're talking about today. And then in addition, we're going to define related party transactions, and we're going to learn how they're accounted for under FAR 31. FAR, of course, is Federal Acquisition Regulation, Part 31. And then finally, we're going to discuss FAR 31 compliant executive compensation. So let's start on our first topic today. The first topic is kind of a indirect cost rates 101, and it's intended to be an introduction or an overview to the subject matter. So if you would like to follow along in your participants guide, please turn to page 3. So I didn't mention this earlier, but if you were registered for this session, then you were sent a participant guide. So if you have a second screen, you can keep it up on the second screen and follow along, or if you have, if you print it out to follow along, that's good also. But the participant guide is intended just to give you a little bit more information, a little more beefy information about the subject matter that we're discussing today. And then also the participant guide is going to have some examples and some problems that we're going to be going over today. So at the District Department of Transportation and at all other departments of transportation across the country, A&E firms are required to submit their indirect cost rates annually. The due date is June 30th for firms with December 31st fiscal year ends. And if you don't have a December 31st fiscal year end, then your paperwork or your submission is due 6 months following the close of your fiscal year. Okay, DDOT's annual financial submission requirements include either an audited or self-prepared indirect cost rate schedule, a certification of final indirect cost rates. And to tell you what the certification is, it's basically a piece of paper saying that you, as the authorized representative of your company, are swearing on the life of your firstborn child that the indirect cost rate schedule that you're presenting is in compliance with the FAR 31 cost principles. So that was a joking there. You're not swearing on the life of your child, but it's basically taking responsibility for the accuracy of the indirect cost rate schedule. So that's required to be submitted every year. And then finally, the AASHTO internal control questionnaire along with all the related attachments, is also required to be submitted. So AASHTO stands for American Association of State Highway and Transportation Officials. So we talked in part one, in the first webinar, a little bit about the AASHTO ICQ. And as we know from that webinar, that is the document that departments of transportation use to kind of look at how you're operating, spot check your internal controls, and to get an idea as to whether or not you have an adequate accounting system. So those items should be submitted electronically to Catherine Valentine's group, which is the DOACD. We're going to try to see if this chat function is working out here. So let's have a little bit of polling question. I'd like for you to answer in the chat. How many of you have gone through an annual financial submission process at DDOT? So if you have, just put yes. If you haven't, just put no in the chat. And I'll give you, 5 seconds or so to answer. Okay, I'm getting several no's coming through. Okay. All right, so then this will be, a couple yeses there, that's good. Okay. All right, so then this definitely, you're definitely going to want to hear about this. And also you're going to want to go back, if you haven't already listened to adequate accounting systems. That's critical in your submission. So you want to go back and view and listen to that webinar at, at a later date. Okay, so if you are a prime or a sub on a District Department of Transportation A&E services contract, it's very important to be in compliance with submission requirements. If you fail to submit your information, and if you're not responsive to all of Catherine's compliance reviewers' emails, then it's likely that your official overhead rate, your indirect cost rate, will be entered into DDOT's database at a 0. So I know that that's very alarming, and you don't want to have a 0 overhead rate in the database, because once it's 0, it's going to take a little bit of time to unzero it. So I want to give you an example of what can happen. So a lot of times firms that are on the A&E schedule, or firms that regularly do business with A&E firms that regularly do business with DDOT, sometimes you might not have a contract in force at the moment. So you're saying, oh, do I have to send this stuff in, or, is it really necessary? But then, of course, there will come a time that you're getting ready to be, that you're placed on a team and you're about to be awarded a contract. And when the Office of Contract and Procurement is ready to go ahead and establish your rates, they look at the DDOT database to see what your indirect cost rate, your approved indirect cost rate is. And if it's 0, it just causes a lot of trouble for you. It will delay the award of the contract, and it may even jeopardize your participation on the contract. So it's very good to know, and to know that the deadline is June 30th, and then also to be proactive in making sure that your latest indirect cost rate is approved. So now this June 30th, so in a couple of months, we're going to look for the 2021 submissions. So before I go any further, does anybody have any questions on the submission process, or what's required, or anything that's been said so far? And if you do, put it in the chat, because that's the only thing I can read. Okay, so I don't see anything there, so I think we will go ahead and continue on. So what are indirect cost rates? An indirect cost rate is simply the ratio between the total indirect costs for your business and an allocation base. In the world of A&E firms, that allocation base is typically direct labor costs. So when you look at this ratio here, we see the formula is indirect costs divided by direct labor costs. So we're gonna go with that's the base, even though of course you do have a couple of options, but this is the common one. So throughout this entire presentation, we're gonna be using this formula for the calculation of the indirect cost rate. Okay, so now that we know what the formula is, what purpose does an indirect cost rate serve? Okay, so an indirect cost rate is simply a device for determining fairly and conveniently within the boundaries of, course, sound accounting principles and within the law, what proportion of indirect costs each contract or project should absorb or should bear. So the information is critical. That information is critical for firms doing business with DDOT or any other DOT, because for A&E services, that rate is integral. It's an integral element in the calculation of compensation fees for services and even for doing your cost estimates. So if you don't know your indirect cost rate, it's really an impediment to doing business with Department of Transportation. So let's just walk through a real basic, simple example of an indirect cost rate calculation. So if you're following in your participants guide, you can go ahead and turn to page 4. So in the participants guide, we have a company called, it's example 1. Let me get my guide so I can read it. Okay, example 1, A&E Engineering LLC has an adequate accounting system that complies with the cost principles of Federal Acquisition Regulations, Part 31. For the fiscal year ended December 31st, 2021, they had $400,000 in direct labor costs and $500,000 in indirect costs. So the indirect cost rate calculation would simply be for A&E Engineering would be $500,000 divided by $400,000 equals 125%. So that is simply the calculation of the indirect cost rate given that information. So indirect cost rates are typically expressed as a percentage. So let's keep this rate in mind. So now we know A&E Engineering, their indirect cost rate is 125%, and we're going to be walking through progressive examples. So let's keep this rate in mind, the 125%, as we move on further, and we'll eventually, pick up on this and kind of bring this calculation further along. So now let's talk about why indirect cost rates matter. Okay. They matter because it allows you to account for costs that are incurred in the operation of your business that are not directly identifiable to your projects or contracts. Okay, we're going to walk through a series of examples, and so we're going to continue this example with A&E Engineering, and it's going to be example 1A in your participants guide. So now that we know the indirect cost rate, let's walk through why that is an important factor. Okay, so for example 1A, it says A&E Engineering was hired by the Department of Transportation under a cost plus fixed fee contract to design a bridge. The assignment was given to Joe. So we see Joe on the screen right here. He's actually wearing a hard hat for some reason. Okay, and Joe is a salaried employee who makes $93,600 annually, and it takes him 1,000 hours to design the bridge. So what I would like, and we're going to assume that they use standard costing at A&E Engineering. So what I would like is for you to calculate direct salary expense and also calculate how much direct labor cost associated with Joe should be assigned to this project to build the bridge. So I'm going to actually give you about 15 seconds or so to, put your answers in the chat. So we have the bridge that's about to be built. This is a miraculous bridge that can be built by designed by one person. He makes $93,600 a year. And what we want to calculate is the direct salary expense. And then we want to know what direct salary cost should be allocated to this bridge project based on this information. So I'm looking at the chat, and I'll give it another couple of seconds to see if anybody actually has the calculation of what direct salary expense is, and then we'll go ahead and walk through it together. So I'm going to pause here for about 5 seconds.
Oh, Monica, we
Okay.
have some answers there, and also we have our sign language interpreter swapped.
Okay, thanks. Great. Okay, so I see an answer here, and we are definitely on the right track. So let's go ahead and walk through this together. Okay, the interpretive swap. Great. Okay, so let's walk through this together. So we know that Joe, he makes $93,600 per year, and we're going to divide that over. In our case, we're using standard costing. We're going to use a 2080 hour year. So that's 2,080 hours in a year. So that means the direct salary expense is simply 93,600 divided by 2080. That will give you $45 an hour for direct salary expense. Okay, next, what we're going to do is we're going to see how much the job cost ledger should be capturing based on him Joe putting in 1,000 hours. So if he puts in 1,000 hours, then that is $45,000. So we definitely had an accurate answer in the chat. I appreciate that. Okay, so that's where we are right now. So since Joe, first of all, are there any questions about this part of the calculation? How we got the direct salary expense, the 2080 hours being the standard amount of hours in a year, and then why you would multiply the $45 by 1,000 hours. It's because that's how many hours he logged in his timesheet that was associated with this project. Okay, now I have a question. So now we know this information. So this is a polling question. Be ready to put the answer in the chat. Let's say Joe was really a part-time worker. So he did earn $93,600 for the year, but he only worked 20-hour weeks. So instead of a 40-hour week, he worked a 20-hour week. So what would his direct salary expense, his hourly rate be if he was a part-time worker that worked 20 hours? And I'll give you a couple of seconds, maybe 5 seconds or so, to try to calculate that answer. Okay, we'll go through that answer now. So if he had a 20-hour worked a 20-hour worked week, then instead of 2080 for his annual hours would be 1040. It would be half. And therefore, his direct salary expense would be $90. So it would be 93,600 divided by 1040, and that's $90 an hour. So the point that I'm making here is that when you calculate direct salary expense for your employees, it has to be based on what their annual workload is. So it's however many hours they work during a year. And that's what you would use as the base for calculating direct salary expense. Okay, excellent. Any questions so far? Okay, so I do have a question before we go to the next slide. So now that we know that this amounts to $45,000 worth of cost, let's say it's time to bill the DOT. Would you bill the DOT the $45,000? Does that relate to what you would bill the DOT? And that was kind of rhetorical. Oh, no. Okay. We got a quick answer there, which was no, it does not. And that is correct, because basically what that is, it's just covering the cost that was associated with paying Bill's paycheck. So we need to therefore build this rate. So we're going to continue moving forward to see what other elements need to be included in this rate, because right now we just have the direct salary expense. Okay, so next what we're going to do is we're going to talk about indirect costs. So you know, as a business owner or as the accountant for the business, that there's more than just direct salary expense that goes into providing services. So those expenses need to be accounted for. You know, examples of additional costs are basically your overhead costs, and they include other things that are necessary to operate your business. So you have things such as matching payroll taxes. You have health and life insurance. You have training costs for your employees. You pay rent for your business, most of you. So rent that enables your employees to have a desk to sit at, you know, a place to go. They light bills, computers, software. So all of those costs are the costs associated with running the business that are not, you know, necessarily project-related costs or costs that are specifically going to be identifiable to the projects that you're working on. So if those expenses for the business added up to $500,000 and your direct labor for the business was $400,000, that would give you the overhead rate. So I just wanted to show you, a little bit more about the fact that you have these direct expenses and they would tie into the cost of doing business. So we have the formula there, which is the formula that we've been using for our overhead rate. It's 125%. Next, we're going to look at the indirect cost rate. So now we know the indirect cost rate is 125%. So that has to be applied to the direct salary expense and combined with that so that you'll capture both components. Okay, so when you capture both components, you're capturing the direct salary expense plus the overhead. So that is coming out to, when you add those together, now instead of us being at a rate of $45, we're now at a rate of $101.25. So that $101.25, it actually is representing what your break-even point is. So what you're doing is you're looking at the money that you pay out to Joe as his salary, and then you're looking at the other costs that sustain Joe, the light bill, the rent, the payroll taxes, all that kind of stuff that's necessary for the operation of the business. And you're applying that to the rate. So for Joe, in a real life situation, you would have to get $101.25 to break even on Joe. So none of us are in the business to break even though, because this still means that your costs are covered, but you've made no money. So we're going to continue now in our progression. But before we continue in the progression, I want to make sure that there's no questions about this portion. So the last slide was the direct salary expense. Now we've added overhead into the mix. Does anybody have any questions about the overhead? Okay. So next, we're going to continue to build this rate. So in the last slide, we calculated the break-even point. So now the final thing that we need to consider is profit. Okay, once you've added the profit, you can properly calculate it, your fully loaded billing rate. Okay, so when working on DDOT projects, 9 out of 10 times your profit is going to be capped at 10%. There are rare instances when the profit can be higher. There's some instances when the profit can be lower. But I do remember an interesting instance where I ran across a contract that I was reviewing where the profit was higher. And in this particular case, it was for a company that installed underwater pilings for bridges. So their workers were divers in wetsuits, and they basically are going underwater to do work on the pilings. So that on that particular contract, there was in excess of a 10% profit that was attached to that contract because the skills needed were specialized. Skills were specialized services that really only happens in a limited number of cases. So for most of you on this call, you can expect when working for DDOT that your profit that's going to be included in the mix is going to be 10%. So that was just something FYI. So let's now go back to our example of Joe and designing this bridge. Okay, so we know that we have the break-even point. So that was 101.25. And next we have the profit of 10%. So the profit of 10%, want to make sure you're noting that it's based on that entire amount. So you get profit on both the direct salary expense and profit on the overhead. So when you add the profit, that's an additional $10.13. And when you add that together, you get your fully loaded rate. So the fully loaded rate in this case for Joe would be $111.38. Okay, so we've now effectively billed our rate. So let's compare this, or let's think back to the cost that we would have had under all of these scenarios. So under the first scenario where we just had the $45, it would have been basically $45,000 that we were billing to DDOT under those conditions. And that you see varies greatly from what you would be billing when you had the fully loaded rate. So that's why the overhead is really important, is because if you see, when you look at this fully loaded rate, the overhead was actually the majority, proportionately, the majority of this rate was overhead. Okay. So any questions before we move forward? We're gonna continue trugging along on this. Okay, so oh, actually, before we go on the slide, this just illustrates what I was saying about the rate. So the 1,000 hours you would have billed, if you just considered the $45 an hour, you would have billed $45,000. But when you have the fully loaded rate, you're billing $111,380. So major difference. So knowing each component that makes up the rate is very critical for you in properly billing and in properly estimating on jobs. So if you don't know your overhead rate, that middle portion, that's the biggest portion of your whole fee, then you're going to be in trouble, because you may be making too much and be non-compliant with the federal laws, or making not even enough to cover your normal business expenses. Okay, so that is something that you want to keep in mind, and that's the use of the indirect cost rate. So next we're going to move on, and we're going to say, now that we know how to develop the fully loaded rate, we know what role indirect cost rate plays in this. Now let's talk about accuracy, the accuracy of your indirect cost rate. Okay, so let's see what happens when you can't quite get a handle on what your real actual costs are and you don't have an adequate accounting system. So if you're following the participant guide, we're actually on page 6 of the participant guide. So now here is the scenario that we have that we're going to look at now. So in example 1D in your participants guide, let's now assume that Ivy Engineering's 125% indirect cost rate was not FAR 31 compliant. So we're very sad because it was not FAR 31 requirement compliant, which is a requirement. Okay, when unallowable costs were removed, the new FAR 31 compliant rate was determined to be 115%. So calculate what the overbilling is to the DOT. So I'm going to give you maybe 5 seconds, 10 seconds to go ahead and calculate that. So we know that what was used was 125%, and we know that that resulted in this billable rate of $111.38 with a total billing of $111,380. So now we know that the corrected indirect cost rate is 115%. And unfortunately, when this contract was reviewed during, a preliminary review, interim cost review, or final cost review, they saw that that rate that was used was not FAR compliant. Okay, so under this scenario where the real rate, FAR compliant rate is 115, this is what would happen. So you still have your 1,000 hours that were worked on this project, but the rate has now dropped from 111 an hour down to 104 an hour. So that means that the amount that you should have billed, if you were billing a FAR, billing in compliance with the contract, your invoice should only have been 104,230. So what does that mean? What that means is that there's going to be a billing adjustment of $7,150. So this is what the impact is, because all of your jobs or all of your contracts are subject to review by Catherine's section, by the DOACD. And it's likely that at some point in time, whether it be an interim audit, final cost, or interim review, final cost review, or whatever, somebody's gonna look at how you're billing and look at your underlying costs. And so this is the result of what would happen. So if it's found that your indirect cost rate was just not compliant, then you're going to have some kind of adjustment. So I want to emphasize that if you present it, let's say you're saying, okay, I have fixed billable rate contracts, so this does not even matter because once the rate is established, it's not subject to audit. So, or not subject to adjustment. It is subject to audit. That's in every single contract that is subject to audit, but it's not subject to adjustment. So I'm correcting myself there. So if that's your thought process, let me give you something else to think about. A requirement of the contract is that you provided a FAR 31 compliant indirect cost rate during that process when the rates were being determined and were being built. So even if you have a fixed billable rate contract, if you gave a totally not FAR compliant indirect cost rate to use in the process early on, the initial process of building the rate, you're going to owe an adjustment. So the only way you would not have to adjust it is if it was FAR compliant. So I'm not talking about you gave a FAR compliant rate and then somebody's trying to adjust it. I'm talking about if your rate was materially misstated in the beginning and was not FAR compliant, you can expect to repay some money to DOT. So any questions on that before I move forward? Well, oh, okay. What happens when there's a billing adjustment? Okay, is money due back to the DOT? Yeah. So when you have a billing adjustment, there could be a number of things that happen, and really, this would be something that contracts and procurement would have to, figure out after they were notified that there was an audit, review or audit finding. But it could just be that your next invoice is adjusted for the amount. That could be what happens. Could be that you cut a check back to DDOT. It could be a number of things. So you would have to work that out with Bill Sharp's department, which is the Office of Contracts and Procurement. Okay, what if the overhead rate is increased? Oh, that's a real interesting response. So I can tell you 100% with 100% surety what happens if you have a cost plus fixed fee contract. If you have a cost plus fixed fee contract, you will get a check from the DOT. So under cost plus fixed fee contracts, the overhead rate is adjusted to the final audited rate at the end, and then whatever way it goes, whether it's to your benefit or whether it's to the DOT's benefit, there is a settlement. So that's what happens now with if you gave an indirect cost rate that was non-compliant for a fixed billable rate contract, and then you find out later that it was really higher than what you gave, I'm not sure what's going to happen with that. So hopefully that does not happen. Hopefully your rate will be FAR 31 compliant when you're trying to establish the rates used in a fixed billable rate contract, and you won't have to deal with that. So, but that would be an Office of Contracts and Procurement question. So I will stay in my lane.
We have
Okay,
a question. I'm sorry. We have a question that how 104.23 is calculated.
Okay, so on this slide. Okay, so so what you're going to be looking at is we're using the same example for Joe, and I think we said Joe's his hourly rate was direct salary expense was $45. Is that right? Yeah, $45. So what we're doing is we're doing the $45, which is the direct salary expense portion, and then we have 45 times 1.15. So it is another $51.75 that has to be added to the $45. And then on top of that, you're going to add the 10% profit. So that's how you come up with that billable rate of 104.23. Okay, so to come up with your billable rate, you've got three components. The first is direct salary expense, which is purely what the guy makes, what Joe makes. He makes $93,600 a year divided by 2080. Okay, it says on standby to swap interpreters. So I'm gonna pause here so we can swap interpreters.
Yeah, now, yes, the interpreters have swapped now. And also we have oh, I'm sorry, you didn't finish the answer for that question. We have another question coming up.
Okay, so to finish that first question, you're going to just take the components, the direct salary expense plus the overhead rate, the overhead, which is the rate times that direct salary expense, add that together, apply the profit, in this case 10%, and then that should give you your hourly rate. So you're just multiplying that by the guy's timesheet. You know, he had 1,000 hours that he put into the project, and that's how you're coming up with the 104,230. So Tatiana, was there another question? Okay. All right. So if we have another question, we can get back to it a little later because I'm not sure if the second question is. So we're going to go ahead and move forward now, and we're going to talk about types of indirect cost rates. So we talked about the indirect cost rate, and we're going to go ahead and we're going to look at the two types of rates that you have. So the first type, so ICR stands for indirect cost rate. So you can have a provisional rate, or like sometimes people call it preliminary rate, or you can have a final rate. So the provisional rate is really like a temporary rate. I call it like a placeholder. And so it's a temporary rate that's used for invoicing purposes for a particular period. And it's used until you can find or identify what final rate is. And at the point where the final rate is established, then you would basically true up your invoices so that you will now, know what the final cost is based on the final rate. So traditionally, your provisional or preliminary rate is going to be your previous year's final rate. So just to give you an example, in the year 2021, so during the year if you're a calendar year firm, you have a calendar December 31st fiscal year end. Traditionally, what you're going to be doing is you're going to be in that year 2021, you're going to be using the audited or the final indirect cost rate that was established for 2020. And the reason why is because you can't establish a final indirect cost rate until after the year is over. So during that year, you're going to be using the previous year's rate as your provisional. And then on a cost-based contract, what you're going to do when you have that final rate established and audited and approved by the DOT, that rate is going to be substituted into the formula, and then you're going to get the final cost related to that contract. And as we had the previous question, it could be higher or lower. So you can owe money, or you can have more money coming back to you from the DOT. So the final indirect cost rate, is, and I'm sorry, I'm reading the chat as I'm also talking. Okay, and I want to make sure I didn't have a calculation error. So Inmar, can you text me a little bit more than the number? Are you saying I have a calculation error? Okay. Oh wow. Okay, let's see the calculation. Okay, so I just want to check my math. I'm having my internal controls in play here. So we have our let's go back. So while we're doing this, let's go back here. So for the 115% overhead rate, so we have the $45 times 1.15, that's 51. Okay, so times 1.10. Okay, so I might have had an error in this. And so thank you for that correction. So on this slide, put a star on this slide, and at the end, I'm going to go through to see if I have. Thank you very much. I'll see if I have an error, because I might have an error in the second calculation. And then what I'll do is revise it before Troy from Equity Inclusion, before he sends out this material, I'll make a change to this slide if there's an error. So it looks like there might be an error. So thank you for bringing that to my attention. Okay, so the concept is the same. So the dollar amount may be up or down a couple of dollars or whatever, but the whole concept of the process is the same. So we're going to go ahead and move forward from there. But thank you for that. So now we're looking at the provisional rate and the final rate. So with your final indirect cost rate, the purpose of it is, number one, it's to establish what your actual costs are for that year. So a final indirect cost rate is absolutely necessary when you have cost-based contracts, because it's necessary to be used to identify what the final cost is related to the project. But also the final indirect cost rate, as I said earlier when we were talking about provisional rates, it can be used as the preliminary rate for the subsequent year. Okay, so it's used to true up cost-based contracts that utilize a preliminary rate or provisional rate as a placeholder, and then it's also used as the rate for the next year. Okay, great. So the use of provisional rates, as I said, are going to always result in some kind of adjustment to your contract cost. And that's because your overhead rate is never going to be identical, because these overhead rates, I'm using whole numbers here. We're using 125%, 175%. But when you're presenting overhead rates, they usually go out a couple of decimals. So it'll be 175.03 or 140.26. So because of that, because of how exact the rates are, it's pretty much unlikely and statistically impossible that your preliminary rate would be the same as the final rate. Okay? So you always, on cost-based contracts, you're always going to have some kind of adjustment.
Hi, Monica. Yeah, so I would like to remind everyone, if you have a question, please drop the question and send it to all the panelists, so all of us can see the question. And we have one over here. It says, is there any need to adjust the billing rate once we have the final rate?
So that adjustment is typically done upon review of the contract. So it's, because usually it's going to be at an odd time, because everyone's auditor finishes at a different time. So you're not going to immediately just adjust the rate. So typically at the close of that contract year, you're going to have the adjustment at that point. Now, if there's a case where it's just something that really happened, most indirect cost rates are kind of consistent, they'll vary. If you have some kind of really astronomical change in your rate that makes you aware of the fact that, man, when this is trued up, you're going to be hit with a big bill, then you should definitely contact Bill Sharp from Contracts and Procurement and let him know that. And that will be handled on an individual basis, because you wouldn't want to keep billing at a higher rate, knowing that you're going to owe money back. Now, if you're billing at a lower rate, they're not going to change that till the end of the contract. That's going to ride out until the end, is what my guess would be. So, so that's my 2 cents on the matter. But yes, so upon contract audit or review, it's going to be trued up. And then also, if you want to intercede because hey, there's a big disconnect here, you can do that with Contracts and Procurement, because they are the bosses of these contracts. Okay.
That's another question. Here. So is your indirect rate affected by multiple contracts?
No, so the indirect cost rate is for your entire company. Okay, so you're going to have the same indirect cost rate that will be is associated with all of your contracts. So the way that you calculate your indirect cost rate is you look at the indirect costs for your company as a whole. And then you're going to be dividing that. So that's the numerator of that equation. The denominator is going to be the direct labor for all of your contracts. So that's how the company-wide rates are calculated. So it's all of your indirect expense for your entire company for the entire year, divided by all of the direct labor for all your different 17 million projects. All of that direct labor cost is added together. So in this case, this little company, Ivy Engineering, they just have this one contract. That's their whole existence, is their one contract. But in the real world, you have multiple contracts, so it's going to be combined. All of your indirect costs divided by all of your direct labor. Okay. Okay. So next, now we know about provisional rates. We know about final rates. Let me check my time. Okay, I'm doing good so far. Okay, so now let's go through another example. Hopefully my math is correct in this example. Okay, so we have ABC engineers. They have a cost plus fixed fee contract, and they're using a preliminary indirect cost rate of 175%. So the agreed upon profit is 10%. That's what you're always going to be seeing in 99.9% of the cases, it's going to be 10%. So ABC's annual invoices for the senior engineer contain 1,900 hours. Okay, direct salary expense was $60 per hour. So now let's ask a question. Okay, so how much did ABC invoice DDOT for their senior engineer? Okay, so we have the components. We have direct salary expense is $60. We have the overhead rate is 175%, and the profit is 10. So I'm actually getting my little calculator out. So before I'm told that this is the wrong calculation, let me make sure I did it right. So let's see, $60. Look at that. This one's correct. Okay. Okay, so let's go ahead and walk through. Now that I did my little spot check. Okay, how much did they bill? Okay, so let's look at the calculation that's involved here. And we're going to ask a second question, but let's go to this one first. Okay, so when you look at what they billed, they have $60 in direct salary expense. They have $105 in indirect costs. They have profit of $16.50. So the loaded rate is $181.50. Okay, so when you multiply that, 181.50 times the number of hours is 1,900. We get 342,950. Is that what we get? 342. Let's see. So we have 181.50 times 1,900. Okay, I'm sorry. We get 344,850. Okay. I'm going to need my glasses. So we're going to take a little pause so I can put them on. Okay. Okay, thank you so much. Yeah, I can't see. I guess I'm getting old. Now I can see. Okay, so I'm not going to be cute anymore. I'm just going to have my glasses on and be able to correctly read. Okay, so great. So this is correct. Okay, we have the amount would be, and thank you, Inmar. We have the amount would be 344,850. So now let's look. So that was the preliminary rate that was used during this contract. So now we have the final rate. So the year has ended. The year has ended, and you now were able to have your auditor, or you did an in-house schedule, and you calculated your final indirect cost rate, and it came to 156. So instead of your provisional rate was 175, but now your final rate is 156. So now we have that calculation. So we still have the $60. We have the indirect cost now based on this new rate is $93.60, and the profit is $15.36. So the new loaded rate is $168.96. When you multiply that by the 1,900 hours, you actually come out to an adjusted billing. The invoice should have been for $321,024. So now you have a difference. So this is what we were talking about in the true ups. So you have the billings that were done at the provisional rate versus what the final billing should have been. So you have a difference there. And so that difference is going to be just the subtraction. And it can be higher or lower depending upon what your final rate is. So in this case, the final rate was lower than the provisional rate. So there is an amount owed to DDOT. If the case was that your final rate was higher than the provisional rate, then DDOT would owe you. Okay, excellent. Yes. so we got the calculation. Great. So that means that you guys are definitely catching on because you've got I see the right answers in the chat. So that's excellent. Okay, so I just want to make an adjustment. So if you do have your participant guide handy, I want you to turn to page 13. And if you don't have it handy, just write this down on a piece of paper. So on page 13, I actually have all these problems are worked out in this book. We have a section of this participant guide that has all the correct answers. So if you go to this example, I want you to make sure you correct these answers based on the screen. So it's the box that would need to be corrected is the first box. Okay, so I just want to make you aware when you go through at a later date, you have to make the correction on page 13. Okay, great. So want to make sure that there are no more questions, and then we're actually going to be winding down this section of the presentation on indirect cost rates, and we're going to be moving on to the next topic. So the final slide that I want to show you here is basically a high-level overview of the 5 steps to developing an indirect cost rate. And so step 1, and this is the 5 basic steps, but really developing an indirect cost rate schedule, that could be a whole 2-hour webinar on its own, but these are the steps that you would have to take. So step number 1 is you would need to start with GAAP compliant financial statements, not cash basis statements, not other comprehensive basis of accounting statements. It has to be statements that comply with generally accepted accounting principles. And we discussed that in part 1 of the A&E Toolbox Series, the need to have GAAP compliant statements in order to have an adequate accounting system. So once you have your GAAP compliant statements, you need to run your trial balance. That's going to be the basis for you pulling all the numbers for developing your indirect cost rates schedule. So the next step is to identify the direct labor base. And typically, when you have your trial balance, if your company accounting system was set up properly, you'll have account numbers that are associated with each of your accounts that are utilized by your company. And normally there's a pattern. So there's a pattern in how the accounts numbering system is set up. So I'll give you an example of a numbering system, a simplistic example. So you may have all of your assets are in the 1000 series. Okay? All of your liabilities are in the 2000 series. All of your equity accounts are in the 3000 series. Then for your revenue may be the 400,000 series. And then your cost of goods sold or cost of services rendered may be the 500,000 series of your chart of accounts. And then finally, everything else, which is all overhead, is in your 6,000 series. So this is how you identify, what the components are. So hopefully your accounting system is set up in a logical way that groups the different types of expenses using, some kind of numbering system. So the step 2 is to identify your direct labor base, and that would be in your cost of goods sold section or cost of services rendered section of your financial statements. Then step 3 is to identify your indirect cost pool, which is going to be everything else. So everything at the bottom of your profit and loss statement in your chart of accounts, that's what's going to be your indirect cost. Okay, so next, you're going to remove your FAR 31 unallowable costs. So that's key. So even though you have your indirect costs, you have all the costs for your company, and that may be great for tax purposes. There's a difference between what you do for taxes and what you do for accounting, okay, under federal aid contracts. So you're going to now have to look at your indirect costs, and you're going to have to remove all FAR unallowable costs. Once that process is done, then all you do is do the little ratio, and you calculate your indirect cost rate at that point. So you have your total allowable indirect costs divided by the direct labor base, and there you go. You get your rate. So yes, I see the question in the chat, is there a list of unallowable costs? And yes, it was actually given in as part of the first of this webinar series. So I can just give you some examples now, but if you want a more comprehensive list and a link to the unallowable costs, listen to the first presentation. So some examples of unallowable costs would include interest expense is unallowable. Now that's allowable for you incur interest when you're operating your business, but it's not allowable for under the federal cost principles. Also, alcoholic beverages. So when you go out, you can go out to a restaurant, but if there's any alcohol on there, you can't charge it to any federal on any federal contract. So no alcohol is allowed. No contributions. Your personal, the contributions in the businesses the not-for-profit businesses you support is a great thing. Boys and Girls Club, United Way, but that's not allowable under the federal cost principles. So that's an unallowable cost. Also, reorganization costs. So if you decide to restructure your business, that's not something DDOT is going to pay for. Okay, so there is a whole list of items that are unallowable. So definitely you would want to get a hold of the AASHTO guide, which I think we have a link in this booklet also. So we had it in the first booklet, but we have a list in this a link to the AASHTO guide in this booklet also. And that's a good thing to. There's a comprehensive list there, and it's unending. I mean, it goes on. So you definitely want to be familiar with it. So okay, and if that's something, if you want to have a separate webinar if you want to have a separate webinar, or if you have some particular elements of this particular presentation that you would want to hear about in more depth, definitely notify Troy from Equity and Inclusion and just let them know your opinions. I'm not saying that'll guarantee that they'll do it, but if they know enough people want to hear about a specific topic in more detail, they're a very open group, so I'm sure that they would work something out. So okay, so now we are going to go on to the next subject. So I'm seeing are we going to switch? Tatiana, do you want me to stop right now? Are we going to switch interpreters?
Oh, no yet. We're going to do like every 15 minutes from now on.
Okay, so just let me know. I'm going to keep on talking until you stop me.
I will do. Okay. Thank you.
You're welcome. So basically that brings to an end our section that we're going to be doing on indirect cost rates. So now we're going to actually move on to the next topic. And the next topic is related party transactions. So if you're following along in the participants guide, I'm at page 8 of your guide. Okay, so related party transactions, they should be disclosed in the footnotes of your indirect cost rate report or audit. These transactions always are going to warrant greater scrutiny because they're classified as less than arm's length transactions. So just a basic example of an arm's length transaction, it's between two parties that have nothing to do with one another. There's no relationship there. They don't have common ownership in companies or whatever. That would be an unrelated party. A related party would be someone where there is a relationship, and it could be a business relationship or it could be family relationship. And we're going to go into the specifics of that a little later. But I want to give an example of a related party transaction. And this example has literally nothing to do with the DOT or A&E firms, but I think it really solidifies what I'm talking about. So let's take a look at the new phenomenon in the United States where you send your kids off to college, they're in school, you're so proud, you're happy to be an empty nester, and then upon graduation, they come back home. So when they come back home, they're living in your house, they're sucking up your air, they're eating your food, and do you charge them rent? Sometimes you don't charge rent. Sometimes they live there for free. Sometimes you do charge rent. Sometimes you charge them such a minimal amount of rent, and what you really are doing is putting that money they're paying away for them for once when they finally move out, then you could give that money back. Okay, so that's an example of a related party transaction, because let's say you were running an Airbnb in that same house that you have. Would you let somebody come in off the street and live in your house and suck up your air and eat your food for free? No, you would not. That's only something that happens when you have a vested interest in that other party, or a relationship with that other party, that you're giving them a break. And sometimes it's the opposite. Sometimes you will pay more for something if it's a related party to help them out, to help the other person out, So that is what the DOT is looking for when they're doing their investigations of related party transactions. They're looking to see if this transaction is something that would have happened if the parties were not related. Okay, so let's talk about the FAR reference for this. And it's going to be listed on another page, but I want to talk about it right now. So FAR 31.201-2 is determining allowability. So what we're doing is we're trying to see how this all relates. What does it matter? How does this related party stuff even relate to the federal regs? So there is something in the federal regs saying that, hey, for a cost to be allowable, it has to meet certain criteria. Okay, so a cost is allowable only when it complies with this whole list of things. One of those things is reasonableness. Okay, so now you're saying, okay, reasonableness. Now let's look at the definition of reasonableness. And that's also defined in the Federal Acquisition Regulations. It's in FAR 31.201-3, determining reasonableness. And it goes into what reasonableness is. And it says, what is reasonable depends upon a variety of conditions and circumstances, including, and one of the things that's listed under there is whether or not the transaction is an arm's length bargaining. So that is why it's important to know, for the DOT to know, if you have related party transactions mixed up in the overhead pool, if some of those costs resulted from related party transactions, because they want the opportunity, the DOT wants the opportunity to investigate whether or not you're letting your kids live free, or whether the kids are paying the same rate that any other person renting your Airbnb, for instance, would pay. So that is what the purpose is. So a lot of times people will get a little bit offended if Catherine's group asks questions like, is there a relationship between your company and this particular person? Because we may see a transaction where something is just really out of whack. Either the amount you're paying the person, you may have somebody who is, I don't know, the janitor for a business, who is a 5-person business. You have somebody who works as, well, let's say office manager, but it doesn't have to be janitor, an office manager. And that office manager for this small business is making $250,000. Okay, when the DOT sees that, and that $250,000 is captured in your overhead pool, when the DOT sees that, the first question they're going to ask is, who is this person? And if it turns out to be the son of the owner, it's going to be problems, because that would be indicative of a transaction that is just not typical, and that would never have happened if if that person was not the owner's son, for instance. So now we're going to move on. Any questions about that? Okay. So now we're going to move on to who is a related party. So the FAR 31 doesn't actually give a list. It doesn't give any kind of clear list of related party transactions. So we're going to turn to generally accepted accounting principles, and we're going to turn to the industry guidance. And so there is Accounting Standard Codification 850, and it defines related party transaction as one that takes place between one of the following. So a parent entity and its subsidiaries of a common parent, an entity and trust for the benefit of its employees, such as a pension or profit-sharing trust that are managed by or under the trusteeship of the entity's management. Could be an entity and its principal owners or managers, or members of their immediate families. So It could be the owners, managers, or immediate family members, or it could be affiliated entities. So that is the fallback definition that a DOT is going to rely on when it's identifying related parties. And so if you have any transactions that take place that fall into any of these categories, you would need to disclose that to the DOT as part of your footnotes in your indirect cost rate audit or in your schedule. Okay, so also another thing in FAR that it's not really clearly defined is what common control is. So I want to define control, and control is also defined in ASC 850. So control, the possession of direct or indirect, so the possession, it could be either direct or indirect, of the power to direct or cause the direction of the management and policies of an entity through ownership, by contract, or otherwise. So that's going to be a factor that is included in the evaluation, is whether or not the person you're doing business with that you gave that great bargain to, whether they have the ability to control or direct, what's happening with the business entity. So this is definitely a topic that has been debated and has been gone over it's a lot of times, but it really is to your best interest to take a look at that, because a lot of small businesses have related party transactions. So you want to make sure that that's not going to kind of backfire and result in you not really knowing what your FAR compliant rate is, because you have some costs that are going to be disallowed upon review because they may not meet the criteria associated with what cost is allowable in a related party transaction. So another thing I want to bring up is that an individual does not need to have over 50% of ownership to have control. So let's say you're doing business with you're renting, because we're going to go into a rental example later. So let's say you're renting your facility from the owner's wife, and that is the wife is part of a real estate management company. So the owner's wife has a 40% interest in the in that real estate management company. Let's say the son has another 10% interest, and somebody else has the remaining interest. So just because the wife doesn't own 50% of that real estate management company doesn't mean that it won't be looked at, that she doesn't control it, or that it won't be looked at for the control, the evaluation of control. So just keep that in mind. And, I guess there's no need to really dive into this in any more depth unless you have specific questions. And normally when you have specific questions on related party transactions, and I've seen this, I work with a lot of DOTs, and I've seen this all the time. If your company has a question about a transaction that you're about to enter into to see how it's going to affect your indirect cost rate, you can make an appointment with the DOT, in this case with Catherine Valentine, to disclose what's going to happen in advance, and then to just get, have a conversation about how will this affect our indirect cost rate, and would this be allowable under DDOT rules and regulations. So you can communicate with Catherine Valentine and the DOACD's group when you do have questions. So the first rule of thumb would be, of course, to contact your auditor or your accountant who has FAR 31 experience. And once you guys have a game plan, then you can contact the DOT to make sure that this is going to be something that's not going to cause you problems in the future. Okay, so now let's talk specifically about rental costs, because this is something, related party rent is the biggest related party transaction that we typically see when we're reviewing indirect cost rate audits or schedules. And the related party rent is also disclosed in the financial statement. So it's disclosed in the audit report footnotes. So it's not something that we really have to think about. It's something that is really right in front of us. All we have to do is read, and because it's a required footnote disclosure. And once we see that, then of course the investigation has to start. So you're ready to swap
Yeah,
interpreters. So I'm going to give, okay, I'm going to give you a few minutes to do that. So I'll pause here for a moment, take a stretch break, and let me know when it's, oh, that was quick. Okay, stretch break is over. Everybody sit back down at your computers because we're good to go again with the interpreters. Okay, so we're talking about rental costs, and I wanted to give this reference to you because I know probably 25% of you are going to have this type of situation if you're the owner of a business, because it's so common. So it's FAR 31.205-36B3. So this is where they're going to talk about rental costs. So charges. So first of all, the cost of renting or leasing personal property acquired under an operating lease. That's what this is specifically addressing, operating leases. So charges in section B3, it says charges in the nature of rent for property between any divisions, subsidiaries, or organizations under common control to the extent that they do not exceed the normal cost of ownership is allowable. So this is the thing with rent. Your limit, you have a limit there that they're giving you in FAR 31205-36. They're saying, yeah, you can have allowable costs from renting between related parties, but that cost cannot exceed the normal cost of ownership. So if you're renting from someone, the cost that you're including on your books can't exceed the cost of that person that you're renting from. Okay, so that's number one. Then also there is a section in FAR 31, and it's actually B2 that talks about sales and leaseback agreements. So this is something that's also extremely, extremely common. So I wanted to bring this up also. In sales leaseback agreements, this is what's happening. So, and this is, you see the reference there on the screen. But what's happening in a sale and leaseback agreement is that it's a financial transaction where one sells an asset and then leases it back over the long term. Therefore, one continues to be able to use the asset, but no longer owns it. So this is often done to try to beat the system. So I want to tell you exactly what I mean so that everybody will understand what I'm saying. Okay, so let's say you have a building and that building is fully depreciated. Okay, so if it's fully depreciated, that means that you basically are left with no, with not what you would consider the bulk of somebody's costs. Okay, so when you would still have your utilities and things like that, things surrounding the use of the building, but your mortgage is gone and the depreciation is gone. So those costs that you would have that could have been reimbursed in the overhead rate are no longer there. So what happens is oftentimes what will happen is, let's say the owner of this business is a woman, so she can sell the building that the company owns. So the company owned the business. She can sell the business, the building, to her husband, and then lease it back at fair market value. Okay, and so it would be the amount, the same cost that everybody around you is paying, on the same street and in the same town and neighborhood, because the fair market value of the building could have increased. So that would result in you now paying rent on the building again, even though it's the same building you used to own that is fully depreciated. So it's kind of you were able to get the benefits during your ownership, like the life that you own, the period of time that you owned the building, but now you're trying to get an additional benefit on a building that you've already fully expensed, basically. So that is a sales leaseback agreement. And that is something that when a sales leaseback agreement is identified, then your rental costs are limited, just like in the other example, to the costs associated with the new owner. Okay, so there's really no way to beat the system. When it comes to the cost principles, they have, totally tied down all of these little tricky things that you can do for, they're not illegal. So we're not saying this is illegal. We're just saying that it's not allowed under the federal acquisition regulations. Okay. Okay, so that's a little bit of an overview. And actually here it is. Here is the, so there is a slide that has the actual regulations there. So I've highlighted in red the key points. So in the sales leaseback, you're allowed, what's considered allowable is only up to the amount the contractor would be allowed if the contractor retained title to that building. And then also in red below, it says what's allowable when you have renting between properties, between divisions of a company, organizations under common control, etc. It means it tells you that the amount that you can claim for rent expense in your indirect cost pool cannot exceed the normal cost of ownership. So the cost of ownership to that other party who now who owns the building. So some typical costs of ownership are things such as this. So the cost of ownership would include taxes paid, the insurance, maintenance and repair, security, interest on mortgage if applicable, the utilities. So the interest portion is actually, interest is an unallowable cost, but the interest is something that is kind of swapped out. There's a way to swap that out using the facility's capital cost of money. So it's really an interest substitute. But to calculate this, you're going to really need the tax return of the person who actually owns the building now. So a lot of times when we see related party transactions and we see that you know, that it wasn't disclosed, or even if it was disclosed, we want to verify that the cost is appropriate and in compliance with the federal acquisition regulations. We'll ask for that individual, for the firm to get the section of the tax return filed with the IRS that covers these expenses. And then we'll use these expenses in the calculation of what the cost should be for the A&E firm that has the indirect cost rate schedule. So that is the section on related party transactions. So there are a lot of other things that could fall under there, but for the sake of time, since this is a three-part, we're doing 3 different topics, we're going to end there. There also could be related party transactions when you're dealing with selling equipment, you know, but rent is like the big one. That's normally the biggest one where you see the related party transactions. So next, we're going to move on to the final topic. If there's no questions so far, let's go ahead and move on to executive compensation. Here is a big, big topic, and that's because if you're an A&E firm, professional service firm, what is your biggest expense? Your biggest expense typically is going to be salaries. And out of that whole group of salaries, of course, the most significant salaries in your group of salaries is typically going to be executive compensation. So there's rules and regulations that are related to that group of employees and looking at their compensation. So the FAR reference for this, if you want to look it up in detail, is FAR 31.205-6. So that is the section that you would look at, and it will tell you right from the horse's mouth what the requirements are for compensation for personal services. So the executive compensation is going to include a whole host of things. It's not just the direct salary expense related to that executive. So in the indirect cost rate calculation section, we talked about what direct salary expense is. We know it's just simply the salary divided by, you know, the number of hours the person works if you're using standard costing. It's more than that. So when you're evaluating the executive compensation, you're going to look at that. So you'll look at the wages. You'll also look at bonuses. You're going to look at pension payments, pension plans. You're going to look at 401k, employer contributions. You're going to look at any kind of fringe benefits, deferred compensation, director's fees, ESOPs, severance pay. You know, you're going to look at like 50 million things that are going to be incorporated in this. So it's not solely just what the person's W-2 income is. It includes all of these other things. So each of those elements, they make up the executive compensation. And what we're trying to determine in the evaluation of whether or not the compensation is reasonable for the work performed. So in the the regulations, what it says, and this is something that's key. It says in the regulations that no presumption of allowability exists where new compensation policies are implemented, where the government has not had an opportunity to review. And it gives a whole bunch of situations where it's saying to you as the consultant that it's your job to prove that the compensation is reasonable. It's not the job of the government or the DOT to prove that your compensation is reasonable. So what is going to happen, though, is when these things are requested and the compensation review is done, that will give the DOT the framework for what its questions are going to be, and then from there you'll have to support what you're paying. So let's talk about the allowability component of compensation. So we just went through several elements of compensation. So what you have to determine, or what the DOT is going to determine if they select, you to review these elements, you want to make sure that each element of compensation is allowable under FAR. So what you have to do is you have to look at the compensation of the executive. You have to identify all of those portions that are going to be included under the definition of compensation. And then one by one, you're going to look at each element and you're going to vet the element for allowability. So that would be salary and wages. It could be the bonus if the person got a bonus, and it could be any other fringe benefits that they get. All of those elements have to be vetted for allowability. Okay, once you, personal use of vehicle, that could be another fringe because you get a certain portion of usage of the vehicle. If it's for personal use, it has to be identified to you, and that's included in compensation for these purposes. So all of that stuff has to be taken into consideration. So the first step, because it's only 2 steps, the first step is to check each of these elements for allowability. Okay, now the next step, once you know that the elements of compensation are allowable, what you're going to do is now you're going to combine all that stuff into one pool, and now you're going to determine whether or not that total amount, which consists of all allowable items, whether or not in total it's reasonable. So there are various ways that you can select to determine or to make the determination of whether or not an item is reasonable. And I can tell you what happens with most firms and most small businesses. So with most small businesses, they're going to be using what's called the National Compensation Matrix. And there is a link, if you have your guide, there is a link in here. Let me see what where it is. So the link to the National Compensation Guide is on page 11 of your participant guide. So you can click on there if you want to see what the whole thing looks like. So what I'm doing is I'm excerpting just little sections of the guide. So let me just tell you what the National Compensation Matrix is. And it's called NCM for short. Of course, everything at the DOT has an acronym. So when people are asking you, did you complete your NCM? What they're talking about is the National Compensation Matrix. So what is that, and who developed it? Where did it come from? Okay, so the state DOTs and the District of Columbia's DOT, it must obtain reasonable assurance that executive compensation costs claimed by engineering consultants is reasonable and that is otherwise allowable. So in an effort to promote consistency with this, what happened is that there was a group that was formed under the auspices of AASHTO, the American Association of State Highway and Transportation Officials. They came together and they got together a group, and that included A&E firms. I think ACEC participated in it. So did some state DOTs. They had some survey, they looked at surveys. So it was a whole team. This was like a real effort to come up with this National Compensation Matrix. And they wanted to put it together as an easy tool to determine the reasonableness of compensation levels for engineering consultants, and so that they can comply with the established criteria in Section 7.5 of the AASHTO Audit Guide. So the NCM team, it began its deliberations in October of 2011, and then the NCM was finally finalized in 2012. So that was several years ago. And so what happens now is every year the DOT will, not the DOT, the National Compensation Matrix team will update the data so that it's current. Okay. We're ready to swap interpreters? I'm going to take a
That's
pause.
weird.
Okay, great. That was quick. We're good to go. So, so the National Compensation Tool, when you go to the website, what you're going to see is you're going to see something like this, and there's going to be a number of years listed. So the tools are specific to different years. So the tool that you should be using should be for now. Like, let's say you're doing your evaluation of executive compensation for 2021. So 2021 just ended, basically. So that's what most people would be doing now, is the analysis for 2021. To do the analysis for 2021, you're going to use the 2022 National Compensation Matrix tool. So make sure when you're doing these analyses that you pick the right tool. So you're always going to pick the tool for the year after. If you're in a calendar year, you're going to select the tool for the year after your audited year. So the reason why it's important to identify whether you're picking the right year is because in making in doing the behind the scenes of how they're determining the reasonableness of each of the job positions, they use current data. So if you're in 2021 and you're using a tool for 2018, that means the numbers are not going to be comparable. So what you would make in 2018 and what would be considered reasonable is going to be different than what's going to be considered reasonable several years later in 2021. So use the right tool. That's often something that Catherine's group, when they're doing the reviews of the indirect cost rates, that's often an audit review adjustment, because we find out that it was by mistake, but the person used the wrong tool. The A&E firm used the wrong tool in analyzing their compensation. So that's definitely step one. So when you pull the tool or download the tool, you'll see it's in Excel. So just in case you're wondering, it's an Excel worksheet. So what you're going to see is you're going to go to the main menu, and this main menu has invaluable information. So at your leisure, you can click on these different links to see exactly, have a it has a full description of what the tool is used for, how to use it. It has an instructions link. It has a position description link. It has Q&A, and it has an example. So it's pretty user-friendly, and it has everything that you need to know how to use it. So this is what you're going to see. You're going to see the main menu. And then another tab. So you'll see the tab. So make note that it's an Excel document, and then you're going to see different tabs at the bottom of the worksheet. So one of the things that you want to make sure that you understand is that, number one, every year there is a nationally published federal cap on salaries. And so that cap for the year 2021 is $568,000. So if you make, or any of your executives make, over $568,000, you automatically know that there's going to be an adjustment, and that all of that is not going to be considered allowable, because that's the cap. Also, additionally, another note about the National Compensation Matrix is that it's meant for a specific range of businesses based on revenue. So if your business makes between 1.5 million of revenue and 500 million of revenue, then this National Compensation Matrix tool is appropriate for you to use. If your company makes over $500 million, then you may want to use an alternative way of determining reasonableness, and that's by purchasing your own salary surveys. So I want to look at the lower end now, because there may be a business that's online now that is saying, well, my business, is under that threshold for revenue. We did not make 1.5 million. And this is what I suggest, this is in my opinion, maybe people may have a different opinion, but I think that no matter what the revenue you have, even if it's below this 1.5 million, you should use this tool. So if it's above, definitely you're going to use salary surveys. But if it's below the 1.5 million, still use this tool as a way of vetting your executive compensation because it's convenient. Okay, so it's convenient. And then if you were to try to vet it on your own, let's say you're $1 million business and you want to vet your compensation, executive compensation on your own since you're below this threshold, what you have to do to vet it is you're going to have to purchase salary surveys, and it's going to be a minimum of 3. These salary surveys are thousands of dollars, maybe $5,000 for one, $7,000 for another. So by the time you get 3, because you can't use internet data, you can't go on the internet and say, what do engineers make? It has to be accredited salary surveys. So that by the time as a small business you spend $25,000 for salary surveys, you could have used the NCM for free. And the results are not going to be that much different than what you would have gotten if you got your salary surveys at such a low, threshold of revenue. Okay. So that's my advice there. Now, another piece of advice when using the NCM, this was not meant for you to be able to read. So you're saying there's all these words and you can't read them. Well, this is just an excerpt to illustrate what you're going to see if you click on a tab in the NCM. So what it does, it has the NCM tool has common positions and duties. And so I wanted to just make you aware of how you should use this. So, because not every company has the same position titles and things like that, but the way that the NCM should be used is by function. So you need to read the descriptions that they give you that are, are listed for the common positions, and whatever that description best fits what your executive is doing, you would give him that title for purposes of the NCM. Okay, for doing this particular exercise. So if your person, the executive that you are evaluating falls into this CEO president category, they're the top ranking executive, principal organizational leader who plans, develop, establish policies. It's the description that you want to focus on, and whatever the description that fits, if the shoe fits, if the description fits, you're going to give the person that title just for purposes of doing this NCM. So it's not the other way around. What you call president, if you're president, if you say this person is president or this person is executive vice president, if they don't do the duties that are in this NCM, you're going to be reclassified upon review into another category. So let's say you call the person vice president, but when we look at the duties of that person are more closely aligned to top engineering exec or something. We're going to give them that title for purposes of calculating reasonableness. Okay, so that's a key thing to know about the NCM and how that works. So the next thing with the NCM is that all of these things, it's kind of like a little integrated tool. So as you put in data, it spits out the answers. Okay, so that's really nice. So another thing that you're going to need to do is you're going to need to enter your revenues into the tool. So whatever your real revenues are, your real exact revenues for the year, you have your GAAP compliant financial statements. So we're talking about the gross revenue per GAAP based on GAAP, not cash basis statements. You're going to drop that into the tool, because what this tool does, it's going to tell you what the reasonable compensation is for these executives by size of business. So if you put that you are a $2 million company, it's going to have a different reasonable compensation for president, for instance, than you would have if you said that you were a $50 million company. So having the GAAP revenue amount in here is essential to you coming out with the right figure. So this is just an example of what you're going to see. You're going to see that once you put in the information, you select the proper titles or positions, you're going to come out with what the National Compensation Matrix says is the reasonable compensation. So if we look at Human Resource Director, for instance, and it says on here on the screen that under this scenario, it is the reasonable compensation for that position is $179,037. So if you at your company have somebody who fit that description, so you designated them as human resource director for purposes of doing this calculation, even if they were called something else, you pay them, let's say you pay them $200,000, then what's going to be required under the federal acquisition regulations is that you eliminate some of that salary because it's not considered, you paying somebody $200,000 for what it's determined is a $179,000 job that's not going to be an allowable cost. So the whole cost is not thrown out. It's just that difference, the difference between what you actually paid the person and what is considered reasonable. So that incremental value is going to be considered a far unallowable cost. And so that analysis has to be done with all of your executives for the company. And in addition, any related parties. So if the related parties fall into some of these categories, then it's going to be very easy to identify they are a related party. You're going to put them in here, and then it's going to pop out what the reasonable compensation is. If you have a related party who is not an executive, you still may be asked to vet or verify that they're being paid an amount that is deemed reasonable. So I had an example, and it actually was not a DC example. It's an example in the state of Georgia where somebody had his son on the books, and the son, actually he had two sons on the books. And one son, so we looked at the compensation related to both sons. One of the sons was 6 years old. So the son who was 6 years old was being compensated at a rate that just was not reasonable based on the fact that, he worked 2 hours, he was already in 5-figure compensation. And it was a 6-year-old who it was not reasonable for payment to be that amount. So with the 6-year-old, everybody automatically agreed to wipe him out, remove him from the indirect cost pool. Now, is it illegal to pay your son? I don't think it's illegal. I mean, I'm not a tax attorney. I'm not the tax police, the IRS police, but I don't really think it's illegal to pay your child. But for purposes of the government participating in that foolishness of paying a 6-year-old 5 digits, that's not going to happen. So another example would be, so the other son, so that was the one son who was 6. He had another son that was, I think he was 21 or 22. He was out of college. And so for that 22-year-old, what he ended up doing, and that there was no adjustment on the 22-year-old. And he was not an executive of the company. He was a staff, he was an IT person, I think. And so what they ended up doing was, because there is no national compensation matrix that goes outside of the boundaries of the executives, what was done was really like a negotiation where he showed, on using more conventional internet kind of stuff, this is what the average person will make who's in this IT position. I have several different sources. He had multiple sources, and then the DOT was able to agree that, okay, that related party person is the 21-year-old or 22-year-old. He was making an amount that was reasonable. So don't be lulled into a sense of security of knowing that you've done the analysis of the executives and that you're finished. So if there are related parties that work for you who don't fall in the executive class, you're going to be required to support that what you're paying those people are reasonable also. So one way to support reasonableness, let's say that with this 22, this was not the case with the 22-year-old, but he was an IT person. He was the only IT person at that company, so it made it a little more complicated. But let's say the son was the IT person and you had 17 other IT people. One way to support reasonable, who were not related. I mean, there were people that got hired under the normal hiring process. They were not related. If the son's salary was right in alignment with all those other 17 people, that's a way to prove reasonableness right there. Any DOT would accept that because your son, was making the same amount as every other IT person you've hired. Okay. Okay, I'm going to pause here. I see it's time to swap. Okay, we're good to go. Okay, so does anybody have any questions on the National Compensation Matrix tool and what it's used for? It's very convenient. Since this came into play, there's been a lot less controversy about executive salaries because the tool basically, governs what's going to be ultimately going to be acceptable to the DOTs. It's kind of like it's not by law that it governs it, but it's mutually agreed that this is an acceptable way to substantiate your compensation. So if you use the tool, it's going to be no headaches. It'll be like a headache-free process in most cases. The only caveat to that is if you pick the wrong title because it's determined that the job duties that you picked are not consistent with the job duties of the person who is performing that. Okay, so not seeing any questions, I will go on to the next slide. So now we're going to talk about some toolbox must-haves. So we had our toolbox must-haves based on the first session, and hopefully you downloaded that information and you started a library so that you'll have some reference materials when you have questions about adequate accounting systems. Now we have another toolbox, and there's a little bit of overlap here, but this is the items, the reference items that you need for the topics that we've discussed. So we've discussed related party rent, we've discussed the national compensation matrix and executive compensation, and we also discussed indirect cost rates. So these are three things that you would need. The gap guide, I kept saying that to create your indirect cost rate schedule, you have to have GAAP financial statements. So if you have any doubt as to what GAAP consists of, generally accepted accounting principles, if you purchase the guide, you can use it as a quick reference. So the GAAP guide is not something you're going to read from cover to cover. It's kind of like a dictionary. If you have a problem or you need to know a word, you look up that particular word in the index and you can go to the guidance on that particular subject. So you can use that as your encyclopedia or your dictionary. So getting a GAAP guide or having your accountant have a GAAP guide is really, it's a good investment. I mean, it's like $100 and something, but it's a good investment to download. I was going to say to get the book, but that's dating myself. So to download it, it's a good investment to download it into your digital library. Also, FAR 31, which is what we had that link also for. We had the link last week for that first session, but as you see here, we've referred to FAR 31 10 million times throughout this session. So it's essential that you have FAR 31 cost principles downloaded into your digital library because it is the foundation for your accounting system. So it has the federally approved cost principles are in FAR 31. Also, the National Compensation Matrix, there is a link to that, and so you need to download that into your digital library and make sure that each year you re-download the latest copy.
Monica,
And
we have a question here. So it says, is an audited or reviewed financial statements needed to come up with an audited indirect cost rate?
Okay, that is a really, really good question. And in a lot of cases, in a good deal of cases, the company will have audited financial statements, and those audited financial statements will be used to as the basis for the audited indirect cost rate schedule. But it is not a requirement to have your financial statements audited before you do your indirect cost rate schedule. So it is more work. So if you're talking about, if you have the scenario where your indirect cost rate auditor can work from audited statements when they're coming in to do their audit, they'll probably charge you less money for their audit. If you don't have audited statements, it's more work for the indirect cost rate auditor, so they're going to charge you more money to do the job. But no, it is not a necessity to have audited or reviewed statements. You could have compiled statements. The only thing that you need to ensure is that those statements are in compliance with GAAP. So once you have GAAP statements, your auditor, your indirect cost rate auditor can come in and do his thing or her thing. Okay.
We have one more over here. For the Department of Transportation work, is there a maximum ICR? Is there a ICR that raises flags?
Okay, well, let me tell you how that works. First of all, no DOT can cap your indirect cost rate. So on a federal aid project, they can on local funds. So on a federal aid project, there is no capping in the United States of America on indirect cost rates. Okay, or if there are, you should have a conversation with that DOT. However, what the DOTs do and what DDOT does, they keep a database of all the indirect cost rates that have been submitted and approved. So there is a database, and then it is known whether you're on the high or low side. And there is, when you are working on a project and you're coming up with allowable costs, there is a budget for that project. So if you have a very, very, very high indirect cost rate, you just might not be affordable. So they're not going to cap your rate, but you might not get hired if your indirect cost rate is so high, because you saw in the developing of the rate what the indirect cost rate does to the fixed billable rate. Like when you develop the fully loaded rate, it really can escalate it. So if your rate is so high, you may make yourself not affordable. But the DOT is never going to say your rate is 210 and we're going to make you drop it to 160. They're not going to say that. Yeah. So one of the things that I do want to, and even though this is kind of like off the top, well, it's kind of on the topic. If you do know that your indirect cost rate is super, super high and it's not in the norm, it's outside the boundaries, you are able to offer the DOT for a particular contract or project, you're able to offer a lower rate. So that is a totally voluntary thing. You would voluntarily say, hey, my real indirect cost rate is 200 and whatever I said, 210%, but I'm willing to offer you 168% indirect cost rate. So if you do that voluntarily, that may make you more affordable, but the DOT would never come in and just force you to drop your rate. That would be something that's totally voluntary. And so, indirect cost rate, I see the question about what's the average rate. And to tell you the truth, I don't know if Natia, if you are on this call, you may have, one of Catherine's people who may be on the call, I'm not sure if they're on now, but they do the monitoring of those indirect cost rates. I haven't looked at them recently. I know that Catherine's group is hot and heavy into finishing up the audits of 2020. So the reviews of the 2020 cost rates. So if Natia or Susan or Chloe, if you are on, if you can drop in just an estimate of what you think the average rate is, then you can do that. But to tell you the truth, I haven't looked. But I know if your rate starts with 2 anything, that's not going to be, that's high, So I know the rates are in the, the 100 range, but yeah. I don't want to actually go out on a limb and say what the average is because I haven't looked at the database lately. So sorry. Are there any other questions? Okay. Okay. Excellent. So next, we talked about the toolbox must-haves, and now we're going to do our recap. Okay, we're at the 6-minute mark. Okay, we're going to do the recap. So basically, the purpose of this, and of course, we only had two hours to cover 3 really intense subjects. The primary focus was on indirect cost rates because that's just so important. So the recap of what we did today is we looked at the basics of indirect cost rates. We looked at how you calculate them, what they're used for, what happens if you have a rate that's incorrect, what happens if you have a provisional rate versus a final rate. So those are the types of things that we really wanted to have the main focus on of this particular webinar. Then we talked a little bit about related party transactions, just to give you an idea of why the DOTs care, who you do business with. And they care because of the fact that the cost principles require them to determine that the amount of cost that you're paying is reasonable for the services or the goods that were purchased or the services rendered. So reasonableness and allowability is why related party transactions make a difference, and why they are scrutinized, highly scrutinized by all DOTs. And then finally, we talked a little bit about executive compensation and a tool that you can use, the National Compensation Matrix, to determine on your own, the reasonableness of compensation. And that's something that it's very, very user-friendly. It's got a lot of good information in there, and I highly suggest that, you spend, a half an hour just kind of fiddling around with the tool, dropping in numbers, seeing how they come out to give you a good idea of what's considered reasonable on a national level. So I see that I'm looking at my little clock here, 4 minutes left. So we're actually made it down to the question slide. So if there are not any more questions, then Catherine, I'm going to turn it back over to you.
Okay, hold on. Well, I think everybody can still hear me, so even though I can't see. So I just want to say thanks everybody for participating. Here we go. And I also want to just piggyback a little bit on what Ms. Miles said regarding indirect cost rate. The information, even if you, in the example, and I wasn't typing fast enough to kind of say this, but in the example that if your overhead rate was in the 200 and you decided to offer a lower rate, this unit still requires that you submit your financial documentation. So I also want to just bring that home. Whether you have, chosen, we still would need to review the supporting documentations of your indirect cost rate. Other than that, I think that the information was very valuable. And if you have any questions, please feel free to reach out to this office. That's all we have.
Okay. Thanks, Catherine. Are there any words from Troy?
Yes. Let me come on camera. Good afternoon, everyone. Again, my name is Troy Parham with the DDOT Equity and Inclusion Office, and I want to again thank everyone today for your participation, the wonderful questions, even keeping us true. So this is a team effort. I want to again thank Monica Miles and Catherine Valentine and our interpreters today for providing service, supporting this great event. We just thank you for your participation and wonderful questions. And please fill out the survey after you leave this webinar, because we want to continue to deliver informative content such as what was presented in this series. So we look forward to everyone's comment. We thank you for your participation, and have a great and wonderful day.